Hi guys, I'm Eva, a mortgage professional talking all things finance. So in today's video, I'm gonna address a question that I get asked quite a lot, especially on the likes of TikTok. And that question being, are you able to get a mortgage as a student? Now the short answer is yes. However, it all highly depends on your personal circumstances. And what I'm about to do is I'm about to go through 3 different scenarios in which that can potentially be achieved. But what I need you to bear in mind is that this is for guidance purposes only. This isn't advice in any way, so please don't take it as such. Always consult an independent mortgage advisor who can assess your circumstances and make a personal recommendation for you. But on that note, let's jump into the video. So let's start with the first scenario. So in this one, you've got quite a lot of savings and you kind of want to get onto the property ladder, but because you're going off to university, obviously you don't want to buy in your hometown and you're not quite sure what you should do. However, the town where your university is based has got some really nice properties that have caught your eye. So you're thinking, right, well, what if I bought my student accommodation for obviously however many years you're at uni for, with the potential of obviously renting out the other rooms to other students and making money that way. Now, I've been able to find a product that does exactly that. It allows you to purchase your uni accommodation and then let out the additional rooms that you're not using to obviously help service the mortgage. But as with anything in life, there are certain catches to it. One of them being that unless you have a 20% deposit to put down, you are going to have to get your parents involved. And basically what the bank will do is they will put a second charge onto your parents' property, subject to them having enough equity in it to then obviously help secure your mortgage. And your parents will also be on the mortgage, so they need to have sufficient income to be able to almost service that or prove that they can service that mortgage. So there is a lot to it. The criteria is quite strict. However, it is an option. So as it has almost an investment element to it, you can actually get this mortgage on an interest-only basis where you're only repaying the interest on the monthly basis. And it's usually for the period of time that you're actually at university for. And then after that, obviously you can review it with the lender as to what you wish to do with the mortgage, whether you wish to remortgage it onto a normal standard resi mortgage, subject to obviously sufficient affordability, i.e. you earning enough income, or whether you're simply going to sell that house and just repay the mortgage in full. But this can be discussed when you're actually looking to take out the mortgage, as it's important to establish almost the exit strategy to this. So the second scenario is pretty much closely linked to the first one in that you've got a bit of a deposit saved up. It doesn't have to be as huge as the 20% that we discussed in the previous example, but you still have a sufficient one. You know, we're talking 10 to 15%. However, your earnings, because you're at uni, you're either haven't got any earnings or they're very low. Now in this case, you could potentially look at what's called a joint borrower sole proprietor mortgage, whereby you're on the mortgage with your parents. So your parents' affordability is taken into account, obviously help boost the figures. However, only you're named on the actual deeds, so you're the only owner of that property, not your parents. They're not named on that deed. Now, of course, the important thing here is the fact that your parents will be liable for that mortgage just as much as you are, as they are a joint borrower. So ideally, you need to have your own income to be able to service that mortgage. But if your only option is for them to actually contribute to it, this is a way in which it can be done. Now, there are a couple of main things that you need to know about this type of mortgage. One of them being that there are additional legal requirements that need to be met. So there will be an element of independent legal advice needed, which can obviously rack up the costs a little bit on the legal side. So you need to make sure you've got extra money to cover the costs. And the biggest one is probably the term of the mortgage. Remember, because your parents will be joint borrowers on that mortgage, the mortgage term will be based on their age rather than your own. So if you're in your 20s, you know, you could potentially go for a 35-year or even a 40-year mortgage easily. Whereas if you base it on your parents' age, you know, you could be looking at a maximum term of, you know, 15 to 20 years, if that, depending on how old they currently are. Now, some lenders will lend into retirement. However, we won't go into that in this video. So what a short short term in effect means is that your monthly repayments will be a lot higher. So once again, all comes down to that affordability. And unless your parents are actually happy to be paying the mortgage on a monthly basis, you'll need to figure out a way to service those mortgage payments from your own income. And the third scenario is where you've got sufficient income, so affordability isn't a problem. So you're either in a full-time position while studying, or you're buying with somebody else, so your combined income is higher. However, you haven't got a deposit, so you've got absolutely no savings, but luckily your parents are willing to help you out by giving you some money towards the deposit. Now, there are certain assisted mortgages out there whereby your parents are able to put that money into a separate account that's actually protected, so they do get that money back, but in effect that then allows you to borrow 100% of the property value. So with this one, it's vital that you do have sufficient earnings, as you're going to have to prove that you're able to service that full mortgage. So despite being able to borrow 100% of the value of the property that you're looking to buy, if you're not able to meet the affordability criteria to actually repay that 100%, obviously this won't work for you. So this solution actually allows your parents to almost gift you the money towards your deposit, but without actually losing that money, without it ever leaving their name. Like, that money will still be in their name and they will get those funds back after a certain period of time. And some lenders actually offer interest on that money, so they'll get the money back plus a bit of interest that it's earned over that time period. So it's another scheme definitely worth exploring. So there you go, guys. Here are 3 ways of you potentially being able to obtain a mortgage as a student. Now, I need to remind you that this isn't guaranteed, so you might not be eligible for any of those schemes. So it's vital that you do speak to an independent mortgage advisor to actually assess your personal circumstances, as they could vary massively to another student's. So this video is for guidance purposes only and not to be taken as advice. So on that note, if you found it useful, please hit that like button and also subscribe to my channel for more mortgage and finance content. Thank you for watching, and I'll see you guys back on Monday with a brand new video. Bye guys.